Okay, and what I was going to do, since nobody else is logged on yet, is I was just going to start recording, and then
Yeah, because I'm just making it home. I hadn't had a chance to look at chapter 14, so I'm just making it in the house.
Okay, so I'll just give you an idea about some of the things that are covered in 14, and then if we have some other people join in, they can ask us some questions too about this. What you're looking at on the screen, let me see if I can make it bigger here, is the very first thing they ask us to do. Oops, now I can't see my device here. Practice exercise 14-1A. Let me get that out in the book so we can read it. And then I'm just going to work through this kind of as an introduction.
Practice exercise what now?
14-1A.
What page that's on?
I'm not sure. Let me look.
Hold on for 1 minute. Let me get me a pen or pencil.
Okay, I've clicked on record. So what I've done is I've muted everybody out. So if you have a question, if you'll ask it on the group chat, then I'll see it down here. And then what I'm going to do is talk about practice exercise 14-1A. And I'm going to get there in the book to figure out which page it is. Let me see here. All the practice exercises are at the end of each chapter. And so 14-1A is on page 668.
You say if I have a what now?
Let me see here. Okay, I'm putting everybody on mute, and then if you have a question, to type it in the chat box. Do you see the chat button? Let me turn you on so I can hear you. Do you see the chat button on your screen? It should be at the bottom of your screen.
Yeah, it was down. Yeah, I see it. I see it.
Okay, good. And so you can type a message in there. Go ahead and try it and see if you can see.
I hit save. Do I supposed to hit save?
Just press enter.
Oh, okay. Did you see it?
Not yet.
Wait a minute. What do I supposed to type it at the bottom of it?
Yeah.
Let me see.
Your cursor should be there in the bottom of it where you would just type right in the bottom. Can you see mine?
Yeah, I see yours. Now I'm going to hit enter. Do you see mine? Oh, I see it.
There it is. Okay. Yeah, and then what I'll do is I'll mute everybody so that when I record, you'll just hear my voice. And then if you have a question, you can unmute. There'll be a button for you to unmute, which is right by your name by the video. All right, so this is practice exercise 14-1A. And I'm going to see if this works. Page 668. Okay, and page 668 talks about the financing plans of a business. And so what it's telling us here is in Plan 1, this company is going to issue $5 million worth of bonds, and we're going to issue $5 million worth of common stock. They're going to issue 0 preferred stock, so that means when it's time to calculate preferred dividends, there will not be any preferred dividends. And so we're going to look at up here, this $750,000 is given. They tell us the earnings before interest and income tax is $750,000, and that's given. And then step 2 is you have to calculate the interest on the bonds. And so here, when you calculate interest on the bonds, and I'll point to that with my mouse, the way you do that, they've got the calculations down here, but you'll say $5 million times 0.07, and the interest on the bonds is $350,000. Because whenever you borrow money, you have to pay interest back, but you can deduct that for tax purposes. Then the third line is income before taxes, which is $400,000. And so what you'll do when you work this homework problem is you're going to set it up just like the example exercise 1 in the chapter. Then you have income before income tax, and then you'll take out your income taxes, and they tell you income taxes are 40%. Let me see if I can find my pen here. There it is, 40%. So you'll multiply 400,000 by 40%, and you'll pay $160,000 to the IRS for your taxes. Then your net income would be $240,000. And when you get here to this number, this $240,000, that is your numerator to calculate earnings per share. So you'll say $240,000 minus preferred stock dividends gives you $240,000 because you didn't pay any preferred stock dividends this time. And then you divide that by a number of common shares to get $1.20. Okay, Belinda, do you see where we are in the book? On page 668.
Can you hear me?
Yes, I can now.
Okay. Yeah. Yes, ma'am. But I'm okay. Now you were saying I'm still lost now. And we on PE 14-1A.
Yes, where you're comparing financing plans. And what they tell us on page 668 is that the company is going to raise $10 million by issuing bonds and issuing common stock. But remember, when you issue bonds, you have to pay interest. And so you have to be able to calculate the interest for the bonds. And the way you do that is $5 million.
Times that 7%.
Yes, times 7% gives you the interest of $350,000.
Mm-hmm.
So what you do is you set up this chart the same way as the example in the book. And once you read the chapter, once you have time to read it, I think it's going to make more sense. But the only thing you're doing is you're evaluating whether or not the company needs to issue stock or issue a bond or issue preferred stock, to raise their money, and how each of those scenarios will affect EPS. And so from chapter 13, you know that EPS is net income minus preferred dividends divided by shares of common stock. And so that's what this half down here, 240,000 minus 0, well, that is net income minus preferred dividends. So that's your numerator is 240. Your denominator is 200,000. You divide.
It's gonna always be a 0 down at the bottom, right there.
Yeah. The reason this is a 0 here is because it's the dividends for preferred stock, and we didn't have any preferred stock with Plan 1. So in just a minute, we're going to go over Plan 2, and we do have preferred stock, so we do have preferred dividends.
Oh, okay.
Okay. So here, from this point on, what you're doing in the bottom half of this chart is you're calculating EPS. So you're saying net income minus preferred stock equals your numerator, which is available for common stock, divided by your common shares outstanding equals your earnings per share, which is $1.20.
Okay, so how did you get that 200?
That is the common shares outstanding. So the way you would get that 200,000 is you would say they issued $5 million worth of common stock, and the common stock par value is 25. So you would have to say 5 million divided by $25 each is how many shares?
Wait a minute. 200,000.
200,000 shares. Right. So to find EPS, you would say 240,000 divided by 200,000, which gives you $1.20. So that's the answer for plan 1, is that earnings per share.
Give you $1.20. Okay.
Mm-hmm. Now I'm going to erase this and then go with the
Is it anyway, before you erase, then
I'm going to go to plan 2. What were you going to say?
I was going to say, is there any way that you could send that to me as an example of what you just did?
Yes, I'm recording what we're doing right now, so I can send it to you.
Okay.
Okay, and then for plan 2, let me get another sheet of paper out. The earnings before bond interest and income tax is $750,000, and that's given. And then your interest on the bonds in
wait a minute, on plan 2, I see on plan 1 that 750,000, so it's gonna be the same at the top on plan 2.
Yeah.
Okay.
Mm-hmm. Yeah, and that's given in the problem there. And then also you'll notice in the book that plan 2 is going to issue common stock. Let me write this here if I can. Well, oh, hold on. All right, I'm going to do this real quick and make sure that I'm recording. Yes, okay. All right, so plan 2, let me find where I am here. Let me get some ink. Okay. Plan 2, we're going to issue common stock worth $3,400,000. Do you see that in the book? Preferred stock, $3,600,000.
That's on page 669.
Uh-huh.
Okay.
Oh, I wrote that one down wrong.
Is that at the top?
Where
I see. It's on 668 at the bottom.
Yes. Okay, so bonds of $3,400,000, preferred stock of $3,600,000, and common stock of $3 million.
So how did you get that $3,400,000?
That's given it where it says plan 2. That's given.
Oh, it's already given. Okay.
Do you see it there? Okay. And then that's bonds here. Okay. And so when you're figuring this out, what they're doing first is they're listing out the income, $750,000 minus the interest. So interest, you have to say, well, the face amount of your bonds times the interest percentage. So you'll say 3,400,000 times 7% to get that number. So
you say what now?
7% times 3,400,000.
Oh, okay.
So what would that be?
You said 7 million. You said 7 million?
No, 7% interest on these bonds right here, 3,400,000. So you would say that times 0.07.
Wait a minute. It's 238,000.
Okay, 238,000. And then that's going to be income before taxes. So you'll take that out, subtract that out, and you have 512,000. And then you have 40% taxes. So then you'll say 512,000 times 40%. It's going to give you your taxes.
And 204,800.
Okay. And then you'll take the difference between those two is going to actually be your net income. So your net income here is 307,200. And then the last part of that chart is to help you calculate earnings per share. And the formula for earnings per share is net income minus preferred dividends divided by shares of common stock. So what we have to do now is we have to figure out, well, this is net income. What are preferred dividends? So you have to go back and look up here at the information they gave us for preferred stock in the instructions. It says that the preferred stock is $1, and then the par value is $20 par. That $1 is the dividend amount. $20 is the par. So you have to calculate how many shares of preferred stock they had to issue to raise $3,600,000. So on your calculator, you'll say 3,600,000
divided by
$20 par. Will equal 180,000 shares of preferred stock. So when it's time to pay dividends, every preferred stockholder will get $1. So you'll multiply $1 times 180,000 shares, which will give you $180,000 you're going to give away when you pay dividends to your preferred stockholders. So that would be the numerator right here in this fraction. So 307,200 minus 180 is 127,200. And then you're going to divide that. This is going to be your fraction here. You're going to divide that by the number of common shares. Well, you have to figure out how many shares of common stock you have. So you'll take $3 million and divide that by the par value of common stock, which is $25, which is given in the problem. So you'll say 3 million divided by 25 is 120,000 shares.
100 and what now?
120,000 shares.
Mm-hmm.
And anytime you divide dollars by number, then the answer is going to be dollars per share. Okay? And so 127,200 divided by 120,000 is $1.06. And that would be your EPS for Plan 2.
Okay. So I can just go back in webinar and just look at this example?
Yes.
Okay.
You can. All right. And then the next one we're going to look at is practice exercise 14-2A. So let me go ahead and set that one up here. If I can get it. It says on January 1st, the first day of the fiscal year, a company issues a bond. And so we're going to look at the journal entries needed for a bond. This bond is a 500,000, 5%, 10-year bond that pays semi-annual interest. Okay, so we're going to get a bond. We're going to issue a bond, and that means that we are going to get cash up front, and we'll give them a bond, which is an official IOU. And it says we're going to receive cash of 500,000. So our journal entry to receive the cash, and this is practice exercise 14-2A, is we're going to debit cash and credit bonds payable because we have to pay back the 500,000 at the end of 5 years. So that would be part A, where you journalize the issuance of the bonds. Got some extra noise here, so I'm gonna mute you for a second and then let me know if you have any questions. In part B, it says to journalize the first interest payment on June 30th. Well, in this particular problem, the interest payment is given, but if it wasn't given, this is how you would calculate the payment. You would say 500,000 times 0.05, 5% interest, times 1/2. And the interest payment is 12,500. So when you pay the interest, you'll debit.
How do you multiply that 500,000 times that 0.5 times 1/2?
Okay, you'll key this in the calculator. You'll say 500,000 times 0.05 divided by 2. Or you can say times 1 divided by 2. Either way. Did that work for you?
Yes, ma'am, I got it now.
Okay, and so your interest payment is 12,500, and then you'll credit cash for 12,500 because you're paying the interest. And then in journal 3, journal entry C, it says at the end of 5 years, when you pay it off, you'll debit your liability, debit bonds payable, and credit cash for 500,000. And that's your journal entry for a bond issued at face value. So this is the bond. This is face value. This is the coupon or the contract rate. And then you have the term, 10 years, semi-annual interest is there. So that's the face amount, and that's the amount you have to pay back. Let me go to another screen for just a minute here. Can you see that PowerPoint screen?
Mm-hmm.
Okay. Oh, I see Angela has joined us. Hello, Angela. Can you hear us?
It looked like she stepped off.
Okay, now what I'm going to do is take us through the slides to this point so you can see where we are in the chapter. When you read through the first part of the chapter in chapter 14, let me give you a page number so you can turn there. But page 645, 646, that has a lot of information that you'll see on the test because you need to read over these and know the types of bonds, the terminology for the bonds, the proceeds of issuing bonds. And let me minimize this for a second. Sorry. And then the contract rate is the rate that you promised to pay. The market rate is the rate that other people are paying on, just banks across America are paying for their interest. And this illustration at the bottom of 645 contains a lot of multiple choice questions because you have to memorize that if the market rate is higher than contract, the bond will sell at a discount. If market rate equals contract rate, it's going to be sold at face amount. And if the market is paying less than yours, then you can sell your bond at a premium, which means more than face value, so you'll get more money. So you need to look at Exhibit 3 as you read through the chapter. And once again, here are the terms: face amount. If it's sold for less than face value, it's discount. More would be a premium. Also, you need to know, and this is explained at the top of page 646, is that a price of a bond is quoted as a percentage. That means that a bond can be sold at 98, meaning 98% of the face value. That would be sold at a discount. Anything less than 100% is a discount. And then bonds can also be quoted at 109, which you would multiply the price of the bond here, 1,000 times 1.09 to get 1090. Sorry. So bonds can be quoted as a percentage. When the bonds are issued at less or more than their face value, the discounter premium must be amortized, and we'll talk about that in just a minute. And then always at the maturity date, the face amount will be repaid because it's a loan. And so this example that I'm going to show you is what we just did on paper. You're going to assume that there's a $100,000 loan, and it has a contract rate of 12%, market rate of 12%, and the term of the bond is 5 years. That means that you're going to sell it at face value because the interest rate on the bond actually equals the market rate of interest. So you'll debit cash and credit bonds payable. And then you'll debit interest expense and credit cash for the interest payment. And then at the end of 5 years, you'll debit bonds payable and credit cash. All right. Hey, Belinda?
Yes, ma'am.
I think I can hear you. Can you mute? Do you see a microphone mute where you could click the microphone off unless you have a question?
Yeah, I can click it off.
Okay. I'm just hearing some back noise and it's on the recording. So if you can do that, that'd be great. And then if you have a question, click on talk and then it'll allow you to talk. Okay?
What is talk? Okay, I just click on the mute button.
Yeah.
It don't have a talk button.
If you unmute, that means talk.
Oh, okay.
Okay.
Yeah. Okay.
Yeah.
All right. I'm going to click on it.
Okay. And once again, here is how you calculate that interest. We just talked about how to do this on the calculator. It's 100,000 times 12% times 1/2. So if you were doing this on the calculator, you would say 100,000 times 0.12 divided by 2. Because interest for a whole year would be 12%, which would be $12,000, but you're only paying interest every 6 months. So you need to divide that by 2. So you'll pay $6,000 every 6 months. So you do need to be able to calculate interest. All right, so here's one we can work together. And let me see here. Angela, I don't know if you've come back to be with us here on the webinar, but let me turn this off. Okay, on January 1st, the first day of the fiscal year, a company issues $1 million 6% bond that pays semi-annual interest of $30,000. We receive cash of $1 million. So here we debit, in journal entry A, we debit $1 million. Oh, I said 1,000, but it's $1 million. We debit cash for $1 million and credit bonds payable for $1 million. And then when it's time to pay interest, we debit interest expense and credit cash. And then at the end of the life of the bond, we'll debit bonds payable and credit cash to pay off the bond. This is an example about a discount, and I'll go through this example and then we'll work one on paper. But it says, assume that on January 1st, we issue the bond, $100,000 bond, 12% interest. It's going to be paid, the interest is paid semi-annually. It's a 5-year bond, but the market is paying 13%. Well, if you can get more interest out on the market than you can from my bond, then I'm going to be forced to sell my bond at a discount. And so instead of selling my bond for $100,000, I actually get cash of $96,406. So that means that my debit cash will not equal my credit bonds payable. So I have to plug in another number. And if you sell it for less than face value, it's going to be discount on bonds payable. And you can remember that discount always goes on the debit side because it starts with a D. The discount on bonds payable is a contra account to bonds payable. So it's a contra liability. It's a contra bonds payable account. It has a normal debit balance. It's going to be subtracted from bonds payable to determine the book value of the bond. The carrying amount or book value is the face amount of the bond less any unamortized discount, or plus the premium. We'll go over the premium next. Thus, the carrying amount of this bond is $96,406. So here they're going to show us on the first day, a company issues a $1 million, 6% 5-year bond that pays semi-annual interest of $30,000, but we receive cash less than $1 million. We receive cash of $936,420. So our journal entry will look like this. You'll debit cash, credit bonds payable, and then you have to plug in the discount because you need a debit, because every journal entry, the debits and credits have to equal. So this is how you come up with the discount on bonds payable. Every period, a portion of the bond discount has to be reduced and added to interest expense. That's called amortization. Amortization is the zeroing out of the premium or the discount. And so here we're going to amortize the bond discount. And there's 2 different ways to do it. You can debit interest expense and credit discount on bonds payable, or you can do it with the interest payment. And in this class, I'm going to test you on the bottom entry, which is where you amortize the discount along with paying the payment for interest. So the 2 methods of computing the amortization of a bond discount are straight line or the effective interest rate. And thank goodness we get to use straight line because it makes it easier. You're just going to divide it by a number and use the same amount every year. So here, our discount was $3,594. The term of the bond is 5 years, but we pay interest 2 times a year, so there are 10 payments. So what you'll do is you'll take the discount and divide it by 10, and I'll show you in just a minute on paper how to create a T account to figure this out. And the amortization of the discount will be $359.40. So when you make the interest payment, here's your journal entry. You're going to debit $6,359.40 for the interest expense. Now, I always wait until the very last thing to total up my interest. The first thing I'll do is credit cash for the amount of the payment of the interest payment, and then I credit discount on bonds payable for 1/10 of the balance to amortize that, and then I'll debit interest expense for these 2 numbers added together. And it tells you here the effect of the discount. If this goes over your head, that's okay. This is not knowledge that's tested. It's just trying to explain why we add the amortization of the discount to interest expense. Okay, and so once again, we're issuing a bond. We've got a discount, and we're going to amortize that discount as an example. And instead of looking at that now, I'm going to go to my sheet of paper over here. So let me get out of here and come here. And now we're going to look at the back of chapter 14, practice exercise 14, 3A is what we're going to work on next. And it says, on the first day of the fiscal year, a company issues a bond, and I'm going to draw the specifications of the bond here. $1,200,000 bond, 9% interest is the contract rate or the coupon rate. It's a 5-year bond. Interest is payable semi-annually. That means twice a year. And it tells us it's going to pay semi-annual interest of $54,000. So the interest payment will be $54,000. If the payment was not given, you would calculate the payment by typing in 1,200,000 times 0.09 divided by 2. Let's make sure I got that right. 1,200,000 times 0.09 equals 108,000 divided by 2 means that twice a year I'm going to have an interest payment of $54,000. And that's given here, but it will not always be given. So on practice exercise 14.3a, they want us to journalize when we issue the bond, journalize the bond issuance. So when you issue a bond, you get cash. So your debit is cash. And it tells us here, receiving cash of $1,153,670. And I'm going to credit bonds payable for the face amount of the bond. And notice I'm skipping some spaces here on purpose. 1,200,000. Okay, so let me get everybody to find the chat box and let's see who's here. If you will, click in the chat box whether you think this bond is sold at a discount or a premium. The face value is $1,200,000 and the cash received is $1,153,670. So is that a discount or a premium? All right, not getting any responses there, but I'll go ahead and tell you it is a discount. You need a debit. And the discount is for the difference between those two numbers. So you have to calculate 1,200,000 minus 1,153,670 equals 46,330. Then we're going to look at the T accounts here. We have a liability called bonds payable for $1,200,000, and we have discount on bonds payable that is 46,330. This is a contra liability account. They go against each other to figure out the book value of the bonds payable. Then what we're going to need to do is we have to amortize, and that's going to happen on the right side over here. Every time we make an interest payment, we're going to amortize this discount until it goes away. So to amortize something means we're going to zero it out. We're going to diminish the value of that account. And the way we're going to do that is through straight line method, which means we're going to take 5 years times 2 payments is 10. We'll divide this number by 10, and every time we make an interest payment, we're going to amortize and credit this account. So this is what the interest payment will look like, and this is actually practice exercise 14-4A. When you make an interest payment, the first thing you'll have to do is calculate the interest payment. Calculate the payment. So you'll say 1,200,000 times 0.09 times 1/2 or divided by 2. And so our actual payment here is going to be a credit to cash for $54,000. We'll have another credit called discount on bonds payable for 1/10 of the discount balance. So that would be 4,633. And then we debit interest expense for these two numbers added together. So it's going to be 58,633. So practice exercise 3A journal entry looks like this. Practice exercise 4A journal entry looks like this one. So that gives you some answers to some homework. And then the premium is going to work the exact opposite of the discount. Okay, so let me go back to where I can see the participants here, and I'll stop the screen share for a minute. And let's see, let's start here. Here I am. I see Belinda. I don't see Angela. Angela, are you with us? Can you hear us?
I'm here.
I can unmute you. Oh, wait. Are you there now? Angela?
I'm here.
Okay, good. She's there. She's just not on video, so we can hear you there. Do you have any other specific questions? Because we have about 10 more minutes. So I want to see if you have any other questions on chapter 14.
I just wanted to go back over, I know you probably covered that part already, but let's see. When we're doing the nature of bonds payable, where we're doing the dividends on preferred stock, where it gets to the part where you deduct the income tax and you come up with the net income. I'm getting a little confused on the dividends on preferred stock.
Okay, how we figured out dividends on preferred stock there?
Because I did one of the this on the homework assignment. I did number 2, but on the second part where I was trying to get to the common stock earnings per share, I think I got a little confused on what I was doing.
Okay. Is it determining the number of shares outstanding?
Yes.
Okay. Let me see.
Because I'm trying to see if I'm dividing and I'm supposed to multiply. Or...
Let's see here. I'm trying to pull it up here. This may be the fastest way for me to get here. All right, can you see my book now?
Yes, I see it.
All right, now if I can just find out how to do it on here. I've got so many screens open, I'm sorry. I can't see very much that I'm doing. Let me make it bigger. All right, and then we're gonna go to 14. Okay. All right, and you said on this one in particular, 14.1b, I think is the one you were working on. That would be problem number, homework problem number 2. Oh, shoot.
Right.
I got off of there. Hold on. Sorry.
Okay.
Here we are. Yeah, here's homework problem number 1. Here's homework problem number 2.
Yeah, 1B. Yeah, that's one of them.
Okay. And so let's look specifically at plan number 2 right here, okay?
Okay.
And let's see if I can find, oh, well. Okay. Plan number 2 is a bond issued at $2,500,000. So you'll subtract the interest out, 10% interest there.
Mhm.
Okay. And then you said you know how to do the net income before taxes, and then you subtract out the taxes. You got that far?
Right.
Okay. And then you have net income, and then the only thing you have left is that earnings per share calculation. Even though it looks like it's part of the chart, the bottom half of the chart, the only purpose for that is to calculate EPS, okay?
Okay.
So what you'll do is you've got to figure out preferred stock dividends, right?
Right.
Okay. Well, in plan 1, that wasn't an issue because you didn't have any preferred stock outstanding.
Right. So that'd be
It was
0.
only in plan 2.
Okay.
Okay. So first thing we have to figure out is, let's look at the details here. It says issue preferred stock, $2.50 stock, $25 par. Well, first thing you need to know is $2.50 is the dividend.
Right.
Okay. $25 is the par. So how many shares of $25 par would you have to issue to get $3 million in return? So you'll divide that out.
Okay.
3,000,000 divided by $25 is
120,000.
120,000 shares, right? And you're going to give out $2.50 to each share. So you'll say 120,000 times 2.5.
Okay, 300. Okay.
300,000.
Okay, I think that's where I was going wrong. I didn't multiply the 120,000.
Okay, so you'll take your net income minus 300,000. That's going to be your preferred dividend. But then you also have to calculate how many shares of common stock it took you. How many did you have to issue to get 2,500,000 shares?
Okay. Be $3.
Well, I just lost the page. Sorry. Can you see it still? Okay.
I still see it.
All right. So then you have 2,500,000 divided by $10 par, 250,000 shares of common stock. Is that what you got?
Right.
Well, my pen just went out, but okay. Let me go and check that amount. What'd you get for EPS for plan 2?
$3.
$3. Let's check it out. See how long it takes me to get it. Nope, that's not it. Sorry, it's taking me a minute to pull it up to check it.
Okay.
And that would be, which problem? Yes, $3 is the answer there.
Okay. I think
And
I got it.
$2.40 would be your answer to plan 1.
Right. Mm-hmm.
Okay.
Okay.
Now, that particular problem won't be tested.
Mhm.
You won't have to work that out on the test. You just
Okay.
have to understand kind of the theory behind debt
Mhm.
financing or equity financing. Because,
Okay.
let's see, I know I'm sharing your screen, but I know you probably can't see what I'm looking at. Let's see. I don't know how to do this thing. I'm learning all this Zoom technology, and it's, I just learned the other one, so I'm a little confused. Okay, sorry. Here we are. Where do I go back? Oh, stop share here. Okay, now I'm back to me. Okay. So the purpose of that very first section in the chapter is to explain if you do borrow money, you have to pay it back, and you have to pay it back with interest. But if you pay interest, you can deduct that from taxes. Okay.
Okay.
So it kind of makes you think about all that, but I don't require you to calculate that on a test. I feel like if you've done it and you can use the chart, then in real life, if you're going to calculate that, you would have Excel spreadsheets and all that. So that's why I don't really test that. The journal entries, once you're studying for the test, you want to learn those journal entries to issue the bond, especially bonds at a discount and bonds at a premium. To amortize the discount, that word amortize just means to zero it out, to make it diminish over time. So don't get hung up on it. Just kind of follow the directions. And I'm going to record some more videos of me working through some practice exercises just to help y'all get used to making those journal entries, okay?
Okay. Thank you so much.
All right. Well, I'll record this as soon as I figure out how.
Okay.
And then I'll upload it and have that available if you want to rewatch it. And that way you can stop and pause and write down with, kind of work it with.
That would help. Be very helpful.
And then let me know if you have any other questions on the discussion board, and I'll be glad to post some more information, okay?
Okay.
Thank you, Ms. Morgan.
Thank you.
Yes.
Thank you so much.
All right. Did you have a question?